Tech stocks recouping some of their earlier losses Tuesday. Fed Chair Jerome Powell testifying before Congress. Let's get a read on that from Max Wolff of Systematic Ventures. Welcome back, Max, and good afternoon.
Always a pleasure. Thank you for having me.
Oh, great to have you with us as always. Now, Max, Fed Chair Jerome Powell said the economic recovery remains, in his words, uneven and far from complete. So what should we take away from this? No rate increases for quite some time?
Yeah, so the market has tended to see all the bad news as fabulous as an insurance that interest rates will stay in the near zero zone and policy will stay accommodative. But I think it's starting to dawn on some people that there's actually a reason for that, which isn't so fabulous, which is that for a lot of folks, particularly the bottom 60 to 80% of the income distribution, and for folks who are less able to work remotely and be kind of seamlessly employed before, during, and after the pandemic, there's been a whole lot of loss here, right? So here in our native New York City, that's basically 200,000 employees still displaced out of the service economy. And it looks like it's going to be a longer, harder road back for them. And I think the chairman is reasonably pointing to that and also pointing to why accommodative policy, fiscal and monetary, is still probably in the offing.
And here to stay for a while then. So what should investors do? We saw tech stocks sort of pare their losses. Should investors go back to buying stocks, or do you think this pullback that we've started to see, you've been talking about for some time now, NASDAQ is down below 5%, more than 5% from its peak.
Yep. Yeah, we're seeing a little burn up on reentry, right? So these are sort of like, these guys have been in this terrestrial, like non-terrestrial orbit here, sort of orbiting around the sun. And I think when you come back down into the atmosphere, the thick air, it's fiery. Reentry is tricky when you're traveling in outer space, which a lot of these things are. So you have a lot of companies trading at a higher multiple to their revenue than they used to trade at to their earnings, right? So there's a lot of room for compression here. I do think there's beginning to be a question of, does the tech world look as good if we get back to normal, right? So there has been this notion, which has a basis and significant basis in reality, that the big tech guys have been kind of massive beneficiaries of the dislocations around COVID, remote workforces, seamless production, life moving online, all the usual reasons. And so now the question comes, hey, if the rest of the world is in the recovery process and you don't have to do everything online, is there a little bit of a pent-up demand to get offline? Right.
And along those lines, we're seeing those stay-at-home stocks really tumbling yet again today. You think there's more to come there in the pullback?
Yeah, I do think the long term is very positive for these big tech stocks. In other words, I think what COVID did is take a future that was 12 years away and make it 12 months away. So compressed time. But I don't think everyone's going back to the office. I don't think everyone's going back to the grocery store. I don't think everybody's going back to the restaurant as often as they maybe did, or as often back to the gym, right? So I think the recovery trade is a little bit overdone and the sell-off's probably a little bit overdone, but all of these shares are expensive. Everybody's priced for their own private version of mutually exclusive perfection. So there's going to have to be a little bit decompression, because one of the jokes is, one of the things America seems to have done, at least affluent America, is buy a lot of stocks and trade them as one of their stay-at-home activities.
Apple's fallen more than 10%. In other words, in correction territory. You were saying earlier the sell-off is a bit overdone. In other words, is it time to start buying these dips?
Yeah, so Apple's had some pretty good news. So Apple did very well on some pretty mediocre news and then dipped on some pretty good news. And not the first, last, or only. But yeah, look, I do think that a lot of this retracement stuff is probably overdone. I think the big tech guys are eating the world. They're also one of the few American company groups that isn't reliant on people feeling positively toward the US to buy American in a competitive world. But I think the markets need to factor what a less cooperative, more nationalistic world looks like. And they need to factor in that the other 80% of America and much of the world isn't coming out the other end of Corona as relatively unharmed as they are.
And lastly, Max, do you think the market should be as concerned about inflation as they are, as we saw this week and last week, given the way that we've seen the yields move?
Yeah, I think the inflation market should be concerned about is equity price inflation, which they don't care about at all.
Equity price inflation as opposed to the economic inflation.
Yeah, because it's running at what 40 times the rate, although no one complains reasonably enough about it. But yeah, I mean, it still looks to me like asset prices are a lot more inflated than macroeconomic push variables as a general rule.
All right. Okay. We'll keep it there. I should note that the 10-year break-even rate hit 2.24% last week. But on that, thanks again for joining us, Max.
Thank you.
Our thanks to Max Wolff of Systematic Ventures. I'm Fred Katayama in New York. This is Reuters.